It's time now for our Muni moment, and according to data compiled by Bloomberg, municipal debt sales on track for a second straight year of declines. States and cities have sold $273 billion of munis so far this year, which is down 8% from a year earlier. Now, at the same time, though, Bank of America forecasting muni sales will rise to $400 billion in 2024. Let's break it down now with Lyle Fitterer. He is co-lead for the municipal sector and senior portfolio manager over at Baird Advisors. Lyle, it's great to have you with us. Do you share Bank of America's optimism when it comes to maybe a rebound here in muni sales?
I think we would share their optimism that we'll have a rebound. I'm not sure we'll get $400 billion. We really don't try to predict what that number is going to be, but I would agree it's probably going to go up. State and municipal governments benefited from the federal stimulus money that helped them. They didn't have to come to market. We all know there's a lot of deferred CapEx per se within the muni sector, whether that be infrastructure or other areas, and so we would expect it to go up. And even this year, tax-exempt issuance is actually up slightly, but taxable issuance is down quite a bit.
And what would that mean for the muni market if we were to see supply return to a more normal level? You know, the narrative we've been hearing is the fact that you've had this dearth of sales has been a bit of a tailwind for the industry. If we go back to maybe more normal levels, will that tailwind disappear?
Yeah, I'd like to think that money's going to start flowing back into munis. It started to flow back into taxable funds. I think we've seen $160 billion or something like that come into taxable funds. Muni funds, at least so far year to date, are negative. But I think if people start to look at the tax-adjusted yield on municipals right now, in some cases 8-9% on a tax-adjusted basis, that compares very favorably with other sectors. So I think it could be a headwind for the market, but our expectation would be that we start to see flows pick up into the industry as well.
Of course, I mean, when we talk about the potential income that you can get, you talk 8-9%. Of course, investors can't just look at it yield alone. Obviously, they have to look at kind of the general makeup of what they're buying here. Yep. And obviously, we know muni market is very vast. So I'm curious, are there certain pockets of the market that you think offer a little bit more, I guess, stability, for lack of a better word?
Yeah, I mean, right now, our focus would be a little bit more what we would say up in quality, so buying higher quality securities. You know, if you look at the yield of a AA rated bond out long relative to, say, a BBB rated bond, it's around 80%, which from a historical perspective is on the higher end. So you don't need to reach for yield. Again, 5% tax adjusted, and again, that would be on the long end. Even on the short end, you can buy stuff at 4%. Yeah. You adjust that for taxes, and you're talking 6-7%. So again, I think it depends on the investor, their time horizon. We are suggesting that people should probably think about pushing out their duration on their portfolio. A lot of people we think are still sitting in cash or T-bills, and they had an opportunity last year around this time. We think it's another opportunity to potentially put some of that money a little bit further out the curve.
But I am curious, when you talk about pushing out duration, I mean, the conviction in order to do that is that obviously you think that rates at least have either reached a peak or are close to it, and you want to lock that in. Is there some sense here that investors really haven't gotten that signal yet and still think that we could see a meaningful increase?
Yeah, again, I think there's a difference in the market. I think if you look at what's going on the taxable side, which a lot of that is more benchmark-focused asset liability mix, we're seeing that already. We're seeing people rotating out of other sectors back into what we'd call core fixed income. I think the muni market tends to react a little bit more slowly. We are seeing it, I think, in direct muni sales to individuals. Mutual funds, though, haven't seen it yet. And so, again, I do think that you do have to have a belief, obviously, that you think you're near the top. You don't have to be at the top of the rate cycle. Even if you think rates are going to stay in a range, whether that be from 4 to 6%, it's probably not a bad time to still tiptoe into the sector. And
so just quickly, maybe it's time to take on some more duration risk. How are you thinking about credit risk right now?
Credit risks, we're being a little bit more cautious. Credit in the muni market, I think, has performed very well. If you look at the corporate market, it's also performed well, but it's stabilized. Credit spreads came in. They've kind of been hanging out at the, at kind of average type levels from a longer term perspective. The muni market, we've continued to march tighter if you look at kind of BBB muni spreads or within the high yield sector. Here recently, maybe with the sell-off the last couple of days, it's cheapened up a little bit, but we're seeing stuff in the market today today at, say, in the high yield sector at a 6%, the same level it was at the end of the year, but high grade bonds are yielding 60, 70, 80 basis points more, so substantially tighter. So again, our view would be you don't need to take that risk. You can get pretty compelling levels by staying in the investment grade sector.